Procter Gamble Co. ticker symbol PG is currently trading at $166.15 a share. They just released their earnings for the second quarter of 2025, and we're going to be going through these right now. Then we'll be taking a look at my automated stock valuation spreadsheet, putting in these latest company financials and seeing if there's a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So let's just have a quick look here at the earnings. Basically, earnings per share is $1.88. They beat earnings, it was $1.86. Revenue is up, was expected at 21.5 billion, and it is 21.9. What else can we see here? Operating cash flow 4.8 billion, net earnings 4.6. Company returned over 4.9 billion to shareholders via 2.1 billion of dividend payments and 2.5 billion of share repurchases. Obviously, this is a big dividend payer, 2.42%, which we'll talk about in a minute, but obviously those share repurchases as well. If we look at the stock price over the last year, it's been all over the place, so they're buying them back. It's been cheaper than it has been recently, so that has turned out to be a good decision for PG. So what we'll do is we'll put in the ticker PG. This will load up all the latest company financial data, including its most recent earnings. If you're interested, please check my Patreon, links are in the description, but let's have a look at PG. $166 a share, just shy of 400 billion market cap, a PE ratio of 28.66, which is lower than the market average, which is 30.4. Earnings per share, $5.80, beta of 0.46, meaning there's a lot less volatile in the market. Analysts say to buy currently $180 a share. Dividend 2.49%, which means you get paid $4.14 per share. In terms of, is it a safe dividend? Yes, it is. 9.7 billion. In terms of the net income, 62, and in terms of the free cash flow payout, 62% as well. If you want to buy the shares, actually buy now, buy today. Well, buy tomorrow based on this, but then you probably have to buy again in 3 months from now. But you can see the ex-dividend date is the 24th of January. So we have the revenue numbers here. Trailing 12 months, 84.35 billion. All-time highs, as you can see here. Now, if we just have a look at the earnings, at the revenue, we'll see where this has come from. 1 second, we have here. This is the 3 months ended of 23 versus 24, and you can see there's up around 2%, 400 million, 21.4 billion to 21.8. And also, if we just scroll down here, we can see the net sales here. What is up? We've got beauty, grooming, healthcare, fabric and home care, baby, feminine, family care, and corporate. And if we have a look at the change versus years ago, baby, feminine, and family care, which is the second largest segment, with 5.3 billion, is up 3%. Fabric and home, the largest segment, 7.5, up 2%. Basically, everything is up as across the board, apart from beauty, which was flat. And overall, that has gave them the all-time high revenues of 84.35 billion in the trailing 12 months. Now, are they able to generate more profit out of this? Yes, they are. All-time highs in profit, 15.48 billion in the trailing 12 months. I've clicked the wrong button there, my mistake. Let me click there. Free cash flow, not the same though, 15.47, but you can see they are consistently generating free cash flow over the years, just shy of their all-time highs in 2024. And if we look at the operating cash flow versus CapEx, we can actually see that operating cash flow is still increasing, CapEx is up ever so slightly. Let me just quickly go back to the sheet here. We've got the consolidated statement of cash flows, cash from operating activities. This is the 6 month ended. In fact, actually, I think they do have free cash flow on the sheet. Just the free cash flow. There we go. Yeah. So it doesn't really show, but you can see here 3.4 billion is the adjusted free cash flow. So it is increasing. Now we'll have a look at the shares outstanding. We know about the buyback program. You can see that they have historically bought back shares to reward shareholders. Okay, let's have a quick look at the discount free cash flow model. This way, valuing stocks, looking at their future free cash flows and discounting them to today's value. Currently puts it at $143 a share. Although immediately, if I look at the weighted average cost of capital of PG, it is 5.3%. So our discount rate is a lot higher. So even if we do 7.5, it is still almost a buy. Revenue growth rates. I think we've got 86 and 87 billion. They've consistently had about 2% a year. Obviously, this is the trailing 12 months, so it's slightly different. but they're expecting 83.4 and 88 billion in 2026. So this is actually, will go 2.5%, 159. Net income margins, I'm pretty happy with that. Here we are, net income to free cash flow to net income. Average is currently about 96% to 8%. So you can see it puts it fairly valued, but as we can see, the weighted average cost of capital is a lot lower. So this is at the very least fairly valued, but definitely has room to grow. Next, we'll quickly look at the Ben Graham fund for intrinsic value. It won't like it. It never does at the minute, but it's worth having it in to kind of see this historically because of the see what they're saying, 6% growth, so less than the S&P. It's not going to be a buy. Let's say 7%, $70 a share. So we'll go past that. Dividend discount model. With the growth of about 6%, a discount rate of 8%, it is more than fairly valued at $200 a share. So looking pretty good. Okay, finally, we will look at the comparable company model. This is a way of valuing stocks, looking at future free cash. Sorry, reading the wrong thing. This is looking at similar companies in similar industries, and then we'll look at certain metrics. The metrics we're comparing are EV to revenue, EV to EBITDA, PE, and forward PE, but we can also compare the revenues, the revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, and PEG. So what we can do is we can type in the other companies we're interested in. We'll do ticker symbol CL, which is Colgate Palm Olive. We'll do J&J, which is obviously Johnson & Johnson. And we'll do KMB, which is Kimberly-Clark. And as you can see, it loads all the latest company financial data for these companies as well. If you're interested, it's $4 a month, what's it called? Tier of the Patreon. I currently have 15 members. It is growing. It's been growing pretty good. I'm very happy with it. I'm very happy that people are using the sheet and finding value out of it. I've got a lot of good messages, and I'm very happy that people are enjoying the product. And I want to keep on improving it. But enough about that. Yeah, so Colgate Palmolive, oral care, personal care, home products, Kimberly-Clark hygiene products, Huggies, Kleenex, and Johnson & Johnson all over the healthcare and consumer goods. So in terms of enterprise value, PG is the largest by quite a bit. Second highest revenue growth rate, EBITDA second highest, net income most profitable, highest margins. We got price to sales, price to book, price to sales. Market average about 3.12. They're all much higher than that, apart from KMB. Price to book as well. PEG, interestingly, we want to be under 1. I might have to have a look at Johnson & Johnson after this, 0.85. A lot of people have been saying it's been undervalued recently, and we can see here. So EV to revenue, middle of the pack. EV to EBITDA towards the top. PE towards the top. And forward PE towards the top as well. So it does put it at $143. So seemingly overvalued compared to some of its competitors, which is quite interesting. But dividend discount model likes it. Comparable company model says a bit overvalued, and the discounted free cash flow model does say it's a buy. Right, guys, thanks for watching. Please give a like on the video if you haven't already. Subscribe if you haven't already, and check out my Patreon if you haven't already. I'll catch you guys next time.